All right, here we go. So, how was everyone this evening? My name is August Williams, and I am Fitness by August. And I have something special for you all. We're going to be talking about financial fitness by way of you want to buy a home, you're ready to move, you're ready to launch out there, but you need information about how to get started. So I have a special guest by way of Titine Hume. She's a level 4 underwriter. She has experience being a level 4 underwriter. She's worked with many different banks, top well-known mortgage lenders and or brokers, if I'm saying that right. And we're going to have a conversation. So, click, like, subscribe, share, do whatever you need to do to get people in on this conversation. So hello, Titine Humes.
Hi there. I was hoping you weren't going to use my full government name, but too late. And hello to everyone out there in YouTube land. Hope this is going to be a value-added discussion. In the last few months, I've had a lot of interesting questions from folks who are just entering the mortgage industry. And my sister thought it would be wise for us to kind of have this talk, and hopefully folks would be able to garner a lot of information. I want to correct August. She said that I was a level 4 underwriter, but just in case mortgage professionals end up seeing this, we don't do levels anymore in mortgage underwriting. We haven't done that in a long time. So I think what August was trying to communicate is I'm a very experienced underwriter. I've been underwriting, 20 years. So a long time is what she was trying to, but level 4 may not translate, especially if you're a newer underwriter, you've been underwriting the last 10 years, you may say, well, what is that? I'm a conventional FHA underwriter. I have my CHUMS or my DE, which is my government designation by HUD. I'm able to underwrite HUD loans, and I have a lot of extensive knowledge in underwriting VA loans as well. So just a very experienced underwriter. But thank you for the introduction, August.
Okay, so what we're going to do is we're going to just, if you're on here and if you have any questions, you can type in. First thing I wanted to go over is, first of all, let me give you a little backdrop. I have bought 3 houses in my lifetime. And each time my sister, Titine Humes, has been kind of behind the scenes, behind the curtain of mortgage lending. She has helped me in a way that was legal and helped me in a way of giving me advice even before I started the mortgage process, i.e. getting me ready, my credit, my loan to debt ratio, when to start looking, making sure my ducks were in order. Before I go to a mortgage lender, obviously she could not originate my loan or anything, but she had gave me some tips that proved to be beneficial to me and my husband, so that we wouldn't make some of the common mistakes as people make when buying their first home. So one of the things I want to ask you, Titine, is what is one of the mistakes that people wanting to buy a home, what would you say their number one maybe mistake, or not knowing, or not sure, one thing that they might do or that they shouldn't do, one mistake they make when now they've decided to buy a home and then they do this and they shouldn't do that? What is that?
I think the first thing, the biggest mistake I would say, and I'm going to give you an answer threefold, but it'll be short. In 2023, the biggest mistake people make is not listening to this re-recording. This is going to be the biggest mistake you make, because there's a lot of information about getting approved for a loan out there in the world. Some of it's not accurate. Some of it has got a whole lot of extra on it, and some of it's just not going to be helpful for you. So in today's world, jumping on a YouTube where you can just get straightforward information wrapped up in a little bun. That's the first thing. If this was 10 years ago, I would say not sitting down and taking a home buyer education course a year before you even think about purchasing a home. You know, if this was 20 years ago, I would have said, start with saving money. So I know I just went backwards, and I can, as we talk, you'll understand why that was important 20 years ago, not so important 10 years ago. And definitely now you just need information. So the most important thing, the biggest thing that people do wrong is by not engaging or getting information, because there's so much of it out there that's not straightforward, before you even start, before you call a lender, before you call a real estate agent, before you talk to your auntie and your uncle. Everything is readily available for you now online. So I think that you should do that first before you reach out to someone who's trying to sell you something, a house, a mortgage, a service. Get the free information that's out there.
Okay. So basically, what you're saying is just since there's so much information out there, just research, but make sure it's the right, because everybody's an expert on this stuff, and they may not be giving you the right information. Yeah. So it's important that although we have this, social media, we have this YouTube, but you can also get the wrong information. You know what I mean? And then you're going to be frustrated and thus delay the process and possibly do something illegal, right? So you want to do it the right way. So get as much information. I guess you're trying to say get up-to-date information, because there's things going on in the background of you just wanting to get to a lender or a broker. There are different laws being passed, rules, things can be done, things can't be, FHA, conventional, all those kinds of things. So how do I set myself up so that I'm not window shopping and then I have a dose of reality? What should I do first besides once, getting all the information? And like you said, you might have said savings at one time. Now it's something different. Yeah. For me, the first time I did the home buying process, I was very discouraged because I went shopping first. I went window shopping, and then just to be told, by you, hey, August, your debt ratio to income is all wrong. You got to fix this up. You got to clean your credit up. You got to go in and you're going to have to answer to these things. What would you say to someone, I guess you would tell them stop window shopping, first of all, because then that puts us in an anxious feeling. Because see, now we're like, oh, we're window shopping. Now we want it. But yet we didn't get pre-approved. We didn't speak to I guess that means we didn't speak to a lender or the broker, or we get any kind of information. Now we're ready. We got a realtor to believe us or let us show a house. And now we want to buy this house, and we don't want anything to get in our way. And that's what causes a lot of problems with doing stuff illegally, or maybe, getting frustrated, and then we're like, what? It's going to take that long? Well, I don't like your answer. Let me go to someone who's just going to tell me yes. Yeah. And then we wind up spending more and doing the wrong things. So with that said, because I've been there, it was much better. Oh, when I tell you, window shopping was a lot better when I was pre-approved. And I'm glad you had me go through that process, even though the hard pull was there, but it was like we were forced to see everything on the table. Do you agree? Although some lenders can do a soft pull and check and whatever, do you agree in this climate with getting pre-approved and then shop? Or are you saying savings, take a look at your credit? I'm sorry, get information, savings, review your credit, pre-approved, then shop?
No, I think this should be the order. There should be the order should be, number one, you and your spouse, you and your family. Somebody says, you know what? I've been told that home ownership is the best way to start building wealth, and or it's getting too expensive to rent because, rents are out of control, and or, I think I would want to be a little bit more permanent with my monthly payments because my rent keeps going up $200 every year. I want something that's a little bit more stable, and or I like this neighborhood. I think I want to put down roots. So the first thing is there's the desire. The second thing is get the basic information. And I know a few minutes ago I said I wouldn't recommend taking a home buyer education course first, but there's a caveat to that. Nowadays, home buyers, it's not a hidden industry. Everyone is talking about it. It's not like as secretive as it was when I first started in 1998, where it wasn't even in anyone's purview. Now, most people understand there's this thing going on with real estate. So what I'm going to say, if you have the patience to sit through a remedial education on getting ready to purchase a home, take a home buyer education class. They're simple, they're online. Fannie offers one, Fannie Mae, Freddie Mac offers one. I don't know what the cost is if you're not in the process, but I guarantee you it's no more than $20. They're not expensive. It's not like back in the day when I first started in this business where you actually went to a classroom and sat down and take the course. They've got great programs. So if you're not too anxious and you can tolerate going through the home buyer education class, that gives you a really good base knowledge. If you are not, Google search, what is the best way to start the process of homeownership? Something that simple. And then go ahead and feed through, you know what to do, hit those top searches, the things that have the most searches, and just start reading. So we're not even talking about reaching out to any professionals, any mortgage people, any real estate, that's not even that. So then you do that. Getting qualified for a mortgage, and this is going to be a newsflash, getting qualified, unless you have complex income streams, is not rocket science. Very, very, for the biggest percentage of individuals in the United States, I can pre-approve you in 5 minutes. For most people, it is not rocket science. It's basic math. It's basic math. It's not confusing. So you go to home buyer education class, and or you look online. However you get the base knowledge, before you even think about, so at that point, you've done either a home buyer education class or you've looked online and you've researched and you go, okay, I kind of understand this. At that point, you should be able to pre-qualify yourself. You don't need an underwriter. You don't need a loan officer because it's basic math.
Okay, can you share some of the basic math with us? What is the formula?
This is the basic formula, okay? Basic formula.
Okay.
Lenders based on the 3 C's: credit, capacity, and then I'll tell you what that is in a second, and collateral. So credit is what your credit history is. Are you likely to repay? And we will go into that in a second. Capacity is how much income you have. And the collateral is the actual property, right? So in order to get pre-qualified, you don't have a property. You won't even know, because you need to know what your credit and your capacity is before you actually, buy a home, pick out a home. Credit is a little bit more involved, but this is what I tell everybody. It's not complicated. Pay your bills on time. You know when your credit cards are due. You know the credit cards you have. You know if you owe medical bills. You know if you have things into collection. Pay them on time, over time, and you don't even have to think about your credit. Just pay your bills on time, and we'll talk about people who don't have credit trade lines in a second. But pay your bills on time, because you know more than anybody. Even if you've never pulled your credit report, you know what what collection notices you're getting sent to your home, you know, the phone calls you're getting, you know, and that's why I like for people to kind of qualify themselves before you even talk to a professional, because you know the information. Okay, so if we're going to start with
wait, let me just stop right there. I like what you said. 1 second. You said pay your bills on time, over time. So I like that. So you pay your bills on time, and then over time, you have what you've actually practiced, right? You've done. You're with time, like they'll say. It even though it took quick to get your credit not the way you wanted it, it's going to take a little time. And sometimes we get anxious, and you know, we're like, oh my goodness, you have all these people, these videos, hacks, how to go up in 100 points, and how to get write letters, and I can get, you know, inquiries taking off. But Titine, let me ask you something. How much does credit score really play a part in you getting
this is very important. This is very important. It plays, credit scores they factor in to how much you're going to pay in interest. And interest at the end of the days is dollars and cents, and it's your money. Okay. So it does impact you. Your credit score impacts what you will pay, how much of your income will have to go towards debt. However, if you are a first-time home buyer and you are getting, let's just say, an FHA loan, and you're already putting down the smallest down payment, or you're getting down payment assistance, you're only putting down 3.5%. So you've got like a over 95% loan to value. I'm sorry, I know I'm talking a lot of terms. Having an 800 credit score is not going to make a difference, because you're already going to be priced at a higher factor because you are putting down less money. And just here as a side note, for lenders, there are a lot of things that go into the decision-making part of if you are a good credit risk or not.
Okay.
Lenders really do consider how much meat you got in the game. So, and this is the thinking. If you are buying a $300,000 home and you put down $100,000, and these are just round numbers to make it simple, lenders feel as though chances are that person's gonna pay that debt as agreed. Because if they don't, we're taking that house along with that $100,000.
That you put down, right?
Correct. So it's more than just your credit score. It's your credit score, it's your down payment, you know, it's other factors. So if you're self-employed, if you're not, there are a lot of other factors, but don't get in the weeds. You don't need to be an underwriter. So you don't have to do that. But you need to be able to qualify yourself. And we're talking about regular wage earners, because self-employed people do sometimes need a little bit more of an analytical person to be able to quantify their income stream. So we're not talking about people who have complex income streams. We're talking about a wage earner, regular W-2 wage earner. And even if you are self-employed, I do encourage people who are self-employed to do what I'm telling you to do. You just may have some issues calculating the income. You follow those same steps. You go to basic home buyer education. You do the same research, because I want you to understand what the basic qualifications are. And then maybe we get with somebody, if you're self-employed, about more complicated income streams. So to answer your question, August, the credit score does make a difference.
Okay.
However, if you are doing an FHA loan at over 95% LTV, that 800 FICO, it's not going to save you that much money. Now, if you are a conventional, if you're going to do a conventional loan, that will help in your interest rate. And if you're not putting down 20%, that's going to affect your mortgage insurance. But I don't want to go into the weeds because we're getting too ahead of ourselves.
Right. Was that the PMI thing they talked about, the extra $100?
Yeah. I don't even want to talk about that, because there are, I'm an underwriter. I've been doing this 20 years, over 20 years. I don't want y'all to have to sit and understand all of those nuances, because this is what I do for a living. You don't need to, that's taxing on a customer. So, but instead, we said, go to home buyer education if you have the patience for remedial level, and if not, and or go ahead and do the research. you know, how do I start to buy what's the process for buying a home? And if they tell you to call a loan officer, they're not giving you the real deal. That should not be where you start, because remember, loan officers make a commission on you getting a loan. So their job at that point is to try and get you a loan. I want people to get educated and then go and look for a loan. And so the factors we were talking about, let me just circle back, because I know I talked about credit, capacity, and collateral. Credit, you need to pay your bills on time, over time. We as lenders, we as underwriters need to know that you are likely to repay. And that's the term we use in the mortgage business. And the only way we can tell if you are likely to repay is if we see historical data showing that you pay as agreed. That's how we determine if you're likely to pay.
Now, what is that? Is there a number? Is that a 12 months, 24 months, 36 months? What is that?
Traditionally, it's 24 months. Traditionally, we look back over 24 months, because in life, stuff falls apart, you know, in everyone's life. So you could have, you know, gotten ill, lost employment, someone could have passed away. We look at the most recent 24 months. That said, underwriters look at your entire credit profile. So if I see a customer who every 4 years, their stuff falls apart, that's in my mind. I'm looking at your credit profile like, this person is 60 years old, and in the last 15 years, they filed bankruptcy twice, even though 14 years have lapsed. For some reason, I'm still seeing that information, because we have other third-party systems we can use to find out what your history is bankruptcy and like that is. So, and such, that wasn't proper English, but you know what I mean. So we take that into consideration when we're analyzing your credit profile. And then we look at,
I just want to back up a minute. You said something important. You said there's a third-party system that you use.
Yeah.
So does it really benefit a first-time home buyer to sign up with one of those other establishments that keep track of your credit?
No.
Because you guys do what? I mentioned you said something to me like, oh no, August, we do a deep dive. We're going to find out everything. So you can tell me, you know, you have a lot of people that call you and say, oh, my credit score on Credit Karma or one of those other Genie or whatever the system is says that I have a 760 or an 800. And that's just the number. But then when you do the deep dive, that's when you discover the foreclosures, went for bankruptcy. Do you guys take that into consider? Like, even though they paid 24 months on time, they're solid, you know, paid on time, overtime, they have 10% reserves in the bank. They've had a job for 24 months. But then you do this deep dive and you find out that 4 years ago, they went to bankruptcy, or they foreclose on their home, or, you know, will that deter you, even though the last 24 months has been, you know, will you look at them differently?
Yeah, we have every lender and every agency. And when I say agency, y'all think of that as FHA, I mean HUD and Fannie Mae and Freddie Mac. So just think, when I say agency, I'm talking about Fannie Mae. You've heard those names before, even if you don't know who they are. Freddie Mac and HUD. Just think of it that way. HUD equals FHA. That's the government. That's government. Or the VA. You know, those are the four bigger entities. They all have guidelines. So they all say, hey, for a conventional loan, so this is not a FHA loan, they say 7 years needs to have lapsed since the date of your last foreclosure or bankruptcy. And it's not the date you filed, it's the date the bankruptcy or the foreclosure was discharged. And if you filed bankruptcy or if you've had a foreclosure, you know what those dates mean. So some of our audience who are listening to this, they may have never even heard of a discharge. Don't worry yourself with this, because this is not going to, it's not going to impact you. But for those of us who looked at credit over the years, I've very rarely met a person who's had foreclosure or bankruptcy who didn't understand there is another layer of waiting period. I was going to call it a penalty, but it's a waiting period before you can get a mortgage or another home. So that's kind of like a one-off, because that's the smaller percentage of the public. who've had that happen. Well, I guess she can't say that because after the last recession, we had a lot more of that than we had historically. But
so is it so because of COVID and everything that's going on in the housing market, whether it's going to tank or whether it's not, it's going to be fine. Is there more foreclosures on the books?
No, foreclosures is, I'm telling you, this market, I never thought I would see anything like this in my life. And I'm sure a really, really bright economist predicted this like 20 something years ago. I feel like I've been asleep the last 10 years and kind of like, what happened? Like, how could we be in this situation? So yes, we could always go through another big recession and people could lose their homes. What's more likely to happen is the interest rates are going to have to go back down after big banks and big government have made some of this money back. And this is just my take on it. I'm not an economist. I don't really follow the markets that tight or anything like that. But after big banks have made back some of their money that they lost when the interest rates dropped down for the last couple of years, they're greedy little, they made more money. After that's happened, then the interest rates, I believe, will start to fall again. Where we're at right now it's not even the United States, it's the world. When we had the recession back in 2008, obviously I felt it earlier, so I can't believe it was actually 2008 because I felt it earlier than that. When that happened, buildings stopped. So they stopped building, new construction. How if you're in the South, this is specific to us, August, outside of the East Coast, you constantly see development. There's land. We have what's called sprawl, all that farms and stuff like that. So people started from, I would say from like 2000 to 2010, builders came down and they said, let's make up all these developments. Let's make all these subdivisions or whatever, because we had land to do it in the South. They also were kind of trying to make sure they had enough housing, because now that there are things called FHA loans where you could put 3.5% down, more people are going to be buying.
So basically, we're still in the situation of there's not enough inventory.
Correct. I was going a long way to say that. There's not enough inventory. Not only is there not enough inventory, I think I read an article the other day that said now we have more, like right now in this point in time, more people who are like home ready, like we're not talking about 17-year-olds. We're talking about people who graduated from college, getting married. There's more of those people right now than there have been since, I guess, post-war, since post-war. And we have all of this inventory shortage. And the interest rates have just gone sky high. So you don't usually have that trifecta. You know what I mean? Usually, it's two of those things, but it's not all three of them. So I saw an article, a thing on CBS News the other night, and they said that homes that are priced at that like $300,000 price point are back to selling in less than a day, because that's really all people can afford. With, I think the rates today are like, FHA rates are like 6.3%. That's all you can really afford for most people, living. So it's just a very interesting time. I don't know how this is going to kind of play out. I really don't, because it's, if rates are high, it doesn't just affect the person buying, it affects the companies buying supplies, it affects everyone. So I don't know. I don't know. I've kind of fantasized a little bit, like, I wonder how this is going to go. I'm clueless.
Well,
I'm really
we
clueless.
definitely know one thing. The rent market is on fire because of it. Since you have all these people who are educated, they're graduated, they've graduated, they have money, they have enough, you have FHA, but then there's no inventory. So now they're like, okay, now we need to live somewhere. So now the rent market is, the rental market is living its best life, so you gotta rent.
I am going to almost cry. I'm so disgusted with big banks, and I love banks. I work for banks. I want to cry. Because literally, as you're talking, my eyes are welling up, because it's a trick bag. You see these banks went out last year and bought up all those built subdivisions of single family homes, right? Mm-hmm. To rent. Yep. Subdivisions are single, specifically for the purpose of that.
Because they know.
The thing is, You're not going to be able to buy a home because they're saying now that people are not even selling their homes. And this is another problem that we have as Americans. So older people usually sell their homes, the inventory gets turned over. They're not doing that. So they're staying in their homes. I guess the only thing we can do is live like Europeans or other cultures where we pile up in a home, not even European, but maybe some other cultures where we pile up generations in a home. Because the thing is, even if when the rental market goes up, like I was just talking to somebody and they said that they knew a person who I know makes menial income, August. Like we're not talking like $100 an hour. This person makes menial income and they're paying $2,000 a month for a 2-bedroom apartment in the South. We're not talking about up there in the South. So $2,000 a month for an apartment. August, if you were able to buy a home for $300 and something thousand, your mortgage payment would be about $1,800.
Wow.
But you can't even buy a home because we don't have the inventory. So they're forced to rent. So these, even though I said I haven't been able to figure it out in my head to figure out how this is going to work out, I guarantee you I know who has figured it out.
Yeah.
You know what I'm saying? We know someone has figured it out if they're building subdivisions specifically to rent single family homes.
Yes.
Why not build those subdivisions to sell them?
Yep. Or a condo or a townhome. It happens to us. I mean, I'm in Eastern PA, but right in Palmer area, Eastern PA, behind a big subdivision, they're renting out these places. There's a Walmart, there's a Wegmans, there's all the stores, and right behind it, I'm thinking they're selling these things. No, they're for rent. And I'm like, why all of a sudden are they built this in 2018, 2019? And now that's what people are doing because there's not enough homes to supply. And because they're actually setting the bar, they're setting the market up. They're setting everything up. So it's real interesting, and without.
I just want to say one more thing about that. People don't think that we can build wealth anymore from owning real estate. You hear people talk. I listen to all the blogs about finance, this, that, and the other. I'm going to talk about a regular person like me. I'm regular plus. I'm calling me regular plus, because I'm not really, really regular. I'm very, very blessed. But a regular person like me, every home that I have sold, I have profited. So you can't tell me that there is not still a path to wealth from owning real estate. And I'm a regular. Now I buy smart, but anyone can buy smart. It's not like I got the.
Well, you just built a brand new home in Charlotte. And that was less than 2 years ago, and you already have value.
Yeah, and that's what I'm saying. Anyone can buy smart. So it's not like I'm like, people be like, oh, I'm an investor, I'm this, that, and the other. I'm a regular person. I don't even have investment properties. I'm just an individual woman. And you just buy smart, because I tell people to do that, make sure you buy smart. Even if you don't profit, 9 times out of 10, think of your home as a savings account you have to maintain. You know what I mean? So if you lived there for 30 years and you paid off your mortgage, think of it as a savings account. Even if you were to back out all the money and expenses you paid over 30 years, I can almost guarantee you would still come out on top. People always know invest. Even if you sold it, I guarantee you take out what you had to maintain it for 30 years, you'd still make some money. So, wow. And then you can pass that along. It was a savings account. So you bought it for $300,000 30 years ago. You paid it off. So now you have that $300,000 sitting in that account. You're going to think of it as a savings account. Even after the maintenance, just because of, that's just what happens. Like things become more valuable over time. Even if they don't increase substantially, there's just going to be normal, everything, matures in cost. So at the end, when you sell it, if you only sold it, which we know is not possible, but let's just say you only sold it for let's just say you only sold it for $400,000 after 30 years. I mean, we know that's not going to happen, but it could. Let's just say only for $400,000. You still got your original $300,000 that you saved into that house, and let's just say over 30 years you spent $80,000 on maintenance. You still walked away with $320,000. And that's a real. I mean, that's the likelihood of you only. It only over 30 years selling for $400,000 it's not likely. So the path to home ownership is for most people the most attainable path to start building wealth and generational wealth. And the banks know it. And the people who know better know it. And that's why you got to be smart in this process. Yeah.
Wow. Well, that was a lot, but it was beneficial. I'm learning something every time, you've helped countless of people make to buy smart, right? Mm-hmm. And family members have bought homes over the last, even during COVID. You've, helped our aunts, our, cousins, and you're right. And when I purchased this home that we're in now, and we closed in January of 2021, they were so eager to get us financing. But they were like, oh, 2 years employment. Oh, FHA, you got 3%. Oh, you have money in the bank. And then we hit a snag. They were more concerned about how we got the $5,000 than any other part of the process. Talk to new home people that are looking to buy a house about that almost caused us not to be able to purchase the home. We had the credit, we had the employment, we had the cash, or we were getting the cash. Everything was right. Mortgage was in the bag, closing. And then it happened. They wanted to know where the money came from, and we had some issues, and we almost didn't close. Like I couldn't believe that after all of that, that was going to be the thing to hinder us from closing. So if I had to do it over again, would you tell a new homeowner or somebody that's looking to buy a house, make sure you have your gift in the bank for 6 months, make sure that gift in the bank, or it doesn't matter. They're still going to have to qualify those funds. They're still going to have to go through. I mean, should there have been 10,000, 7,000 sitting in the bank 2 years? Yeah. Speak to that, because that was almost a fail.
I think, I talked to a young lady at church about, she wanted to buy a house. And I tell people this, I tell everybody this, if you want to be patient, I really think people should start this process 18 months out. If it were up to me, and I'm telling you,
that's good to know.
In August, I'm gonna tell you now, and I want you to write that caveat though, because there is a caveat to that. I think 18 months in a regular normal market, you get the little taste. Maybe we should own a home. From that moment, 18 months down is what we're planning it. Unless you're a person who has like a high income, you make a lot of money, you don't necessarily need to do that. But I'm gonna tell you why for the normal person. Most people are just 2 paychecks behind being out on the street. You know what I mean? Most people don't have tons and tons of saving. When you have 18 months to prepare yourself, when you start doing that first, like little research that we talked about, the remedial home ownership courses, they teach you about budgeting. And I like to see people practice paying a mortgage for 18 months before they close on a mortgage. If you practice that in theory, and I said one day I'm actually have a school for this. So people can practice, so let's just say you're paying $1,500 in rent every month. And because you've done a little research, you took this home buyer education class and you've done your thing, you've qualified yourself. You've never even talked to a loan officer. You've qualified yourself. I want you to start paying a mortgage of $1,800. That's what you qualify for. Pay a mortgage of $1,800 a month. So you pay your rent for $500, save that extra $300, for 18 months, and then start putting away your savings for the purchase of the home. So just to get used to what it feels like, because for a lot of people, it's like bam's the first thing. So to answer your question specifically, back in the day when we used to do jumbo loans and non-conforming loans, we used to do something called seasoned and sourced. So your money had to be in the bank a certain amount of time. It used to be like 60 or 90 days or whatever. There's no guidelines about that anymore. Well, I take that back. like jumbo loans, and this is not, I'm not talking to a jumbo customer right now. Jumbo loans are for people who have high net worth. They do have some kind of seasoning, because those are more like non-QM. Oh, I didn't mean to use that word because that's a technical term. I'm gonna stop doing that. But like jumbo people who are buying multi-million dollar houses, they have some different requirements. But for the regular person purchasing a home, you don't have to season. You don't have to source. I'm gonna tell you this though. After you go through the remedial home buyer education, do framework. That's a good one. Fannie Mae, write that down, August. Fannie Mae's framework is the home buyer education course that it's really good. It's remedial, but it's good. And then you've gone online and you've learned about the process. So now you can actually qualify yourself, right?
Uh-huh.
If you get with the right loan officer, oh shoot, August, this is tough for me. This is a tough conversation. Oh gosh, I gotta.
So what do you mean right loan officer? How do you know that you have the right loan officer?
You don't, but that's not the problem that I'm having right now. That's not the problem that I'm having. I'm having a problem because the reason that your gift ended up being a thing is because years ago when we had—
You mean my gift, the gift money?
Yeah, because I want to circle back, and I hope folks are following me. I'm really, right now, I'm actually having a struggle, August, of ethics, and you're going to understand why in a second. Before 9/11, remember there was a terrorist act at the World Trade Center?
Yep.
Remember that? Well, they found out when that happened that people were doing, we were getting money into the country from people doing money laundering. Some of the things they were doing was with buying homes and stuff like that. I don't want to get complicated, but I will say that money laundering was an issue back then. And so the reason that there are so many strict guidelines on, hey, where'd you get that money from? Where'd that money come from? If it was a gift, it has to look like this, because if it's not that, we know it's not a gift. A couple of reasons. Nowadays, it's not because of money laundering. Nowadays, we know what you're doing is you're structuring. And I just gave out an industry term. It's called structuring. We know you're probably structuring. So we're not going to let you easily do something slick, use some money that is not yours as a gift to put down in our transaction where we're lending you money. So a gift has to be a bona fide gift. A gift has to be, August, I'm your relative and I'm giving you $50,000, no strings attached. You ain't got to pay it back. I'm giving you. When that communication is made as a gift, we need to prove that's a gift, because technically you could have went out and got a loan for $50,000, gave it to your auntie and said, Auntie, give me this money back and funnel this money to me, saying it's a gift. Right? And nowadays we can catch stuff because we pull credit reports right before closing. But back in the day, we didn't pull a credit report right before closing, or we did a soft pull, back in the day. So we didn't always catch that really was a loan that you got, that you took money out of, or you got a new credit card and you pulled down $4,000, gave it to your aunt, had your aunt put it in her bank account and then transfer it to you. Or, people do crazy things instead of just doing what's right. So if you don't prove that it was a gift, it came from a bona fide source, it was a gift, to us, we don't know if that was just you just got a credit card or if you are doing money laundering. Banks are not going to get on, and we're trying to prevent that. We don't want any of that, to happen. And in addition to that, if the picture that you're painting is, so let's just say it wasn't a gift, but it was money in your account and just popped up. In theory, you say, I was saving this money under my mattress, because it's called mattress money. You're allowed to do that with certain loans. I've been saving, because back in the day, all these people did that. People put them in jars every week. They cash their check. Right. They just say.
So you can do mattress money. You can do jar money.
It depends on the investor. It depends on the investor. I gotta check with FHA. I can't remember if I think FHA got rid of it. I think they got it. I don't even know. I have to look and tell you. But this is just the example I'm giving you. If you were saving your money under the mattress and you put it into the account, to me as the lender, you are a good risk, because I can see where every week you gave me paychecks showing that you cashed $1,000 and you have a history of saving. So to me, you're shown to be reliable. If that never happened and you really just got a loan and you sneakily got it in your auntie's name and co-signed it and gave it to your cousin, that comfortability that I have that you have a history and the discipline to save has now gone away. So there's a lot of reasons that lenders give you a hard time. It's also because like I said, two things. We want to know that you historically like to save, because if I feel like you like to save, I feel like you're going to be more disciplined. And these type of things are not like when I, as an underwriter, and am underwriting your loan, there's nothing in the guidelines that say, hey, do they have a habit of saving? These are just things to kind of strengthen. Like when I'm summarizing, giving a 97% loan to value to a customer who has marginal credit scores because 7 years ago they had a bankruptcy, when I'm writing up my synopsis as to why I think you are likely to repay, I literally say they have a history of savings. They have 8 months of reserves after closing. For the last 24, 36 months, they've paid on time. The prior slow pays or derogatory reporting looks to be isolated incidents. So I'm taking all those things into consideration when I am analyzing you as a customer. So the long story is, that's why we want to know about how that money got to you.
How you got the gift money, and that could be a deal breaker. You just mentioned something. You just actually, I don't know if you know, but you probably did. You just gave a formula for the ideal. You're an underwriter. Yeah. You're the one that says, yes, this loan, give them that house. You're either going to make someone's dream come true. Yeah. You're either going to start a family off with generational wealth. You have all that power in your hands. And you just gave off three things. You just said, oh, I see 7 years out from their bankruptcy. That's your grace. I see 8 months of reserves after they have 8 months in reserves. If something should happen, once we give them this mortgage, and they have their down payment and they have their closing costs, their credit is good. Everything is answered for. But Titine, how many of those type of people do you encounter? Because I just feel like that's an anomaly. Unless I'm wrong, maybe there are new people starting out that have 20, what did you say, 8 payments times 2,000 a month. Maybe they have in reserves. So is that the real picture? Should we, after we take this Fannie Mae course, after we take this, should we be, and now it's going to be hard if we're not making that kind of money. But if we really want true home ownership and we want to fast track it, should we really have those? What did you say the credit score needs to be? Even though you said not only the credit score, what is it, 680?
No, you technically, for FHA loan, that's up to the lender, because you really don't have to have a score. You can have no score. You don't have to have credit for an FHA loan. So that's why I'm saying, don't get hung up on the score with FHA loans. Okay,
all right. So let's say I have a 650, right? And I got a couple of 30-day lates, right? But I have 4 months in reserve. I have $8,000 in the bank. It's not 8 months, but it's 4 months, right? So 4 times 2, I have $8,000 in the bank, but I also have a gift that's been sitting there. It's been verified. It's been marinated and it's sourced, however you call it, seasoned.
You no longer have to source or season. Yeah.
Okay. Okay. So it's in there. I got this gift. It's sitting in there for $6,000, and I've been working for 24 to 36 months. And, I have a history of paying all my bills on time. Are you automatic? You're like, oh, stamp, approve, move on.
Yeah. And you just said something. I got to make this point so people understand underwriters. I have the ability to approve or decline a loan. However, there is oversight. As of, I started in a mortgage broker, I think 1998 or 1999. If we declined a loan back then, we just declined the loan. So I could just not like the way you look. I could just not like the way you look and decline your loan. Not to say you wouldn't go somewhere else and get a loan, but there's oversight. If I decline a loan, August, let me tell you, if me, Titine Humes, decline a loan, you better believe, I make a recommendation to the client. Chances are that loan should be declined, because the example that you gave about a couple of slow pays, those customers are the ones that are the trickiest. People who have slow pays, those are the ones that are harder to underwrite, because they're not just a bad credit risk where you can be like, yo, they have problems. And they're not a good credit risk. So those are the people that you have to dig for, to look for other, we call them compensating factors, right? The first question you asked me is, the scenario that I gave you, how often do I see that? I don't know who our audience is, but I talk straight, so I'm going to talk straight. And I've been doing this long enough to be able to say this. When I first started in this business, I did start as a loan officer. If you can remember, I worked at Leadership Mortgage, and I was originating loans in Atlanta, mostly African-American people. August, back then, we was pulling it together. Your aunt is giving you $100. People, we couldn't even get them to the finish line, because, you know, that's how the customers were. They were not as credit ready, but it doesn't make sense to pay $1,200 in rent if you can buy a house for $1,200. So my customers at the time, it was an average Joe who didn't even know this information, because that was in 1998. You know, it's a long time, 20-something years ago. When I started working for the banks, I'm going to tell you, I hate to say this about us. I play a game every time I open up a loan. You know, when we open up loans now, you don't look at the customer. I don't go and look and see what nationality are you. You know, we don't do that. You know, I hope people are not doing that. Like, that's not even where your mind is going. I'm just talking straight.
Right.
If a person's name is John Adams or you know, Mike Smith, I don't know what the race is, and I'm not even thinking about that. I can actually review their credit profile, their bank statements, and their job history. Ugh, I hate to even say this. And I can tell you what nationality they are.
Wow.
We struggle. And so I was giving you the answer that I was giving you about how often do you see that profile. We're only 14% of the population, August, and most of us are not homeowners. So the other nationalities, other races, I see mostly that scenario. They have already 24 months out. They have parents who have homes. You know, a lot of us are first generation. So the parents, what I just said about the 18 months, the parents said, hey, in 2 years, we need y'all to buy a house. So this is what they're going to walk them through this process. So they start the savings. They start building up the credit. You know, parents put them on, you know, credit cards at 18, and not even just on credit cards, August. You know, people say, oh, put your children on a credit card at 18 so they get the credit history. Back in the day, it wasn't that they put them on the credit card, they gave them a credit card so they could get used to managing debt so that they could be responsible. They literally would say, okay, here's a credit card, use it in case of emergencies or, you know, whatever the situation is.
Right.
To start getting them used to, you know, building that character of paying your debts and, you know, just the whole entire thing. But so the sad answer is 90% of the time, depending on where I'm sitting, that scenario with the 8 months and the is what's happening. That's actually 90% of the time it's happening because we're such a small percentage. But I will tell you, August, I play a game.
Wow.
The hardest part for me to underwrite in a loan, I know people don't want to hear this. The hardest thing for me to underwrite in a loan is assets, because I gotta underwrite your credit. I could do that in my sleep just because of how I started. We got to underwrite the collateral, the property, but your assets. So I get a person's bank statements, and now it's very automated now. Remind me to circle back to this because I got to tell y'all something not to do when you're getting a mortgage about how you give the lender your bank statements. Remind me to circle back to that. But they give me the bank statements and they send over 2 or 3 because the loan officer's sloppy or the processor's sloppy. We only needed 1 and they gave me 3. Well, because they gave me 3 as an underwriter, I'm obligated, with most companies, they tell you this, depending on who you work for, I'm obligated to review every daggone, you know, line item on those bank statements. So I hate bank statements, August, because it's tedious. You know, I don't have great vision, you know, and you're looking at these lines, everything is automated. It's back in the day, we had these thumbs, we could look through the paper, everything's automated. So it's on my screens, you know, you got the 2-3 screens. I got to go through every line item. By the time I'm finished, halfway down 1 month, I know what their nationality is. And I am surprised.
And I'm not even going to ask you because I don't even want.
Well, and this is, I will say this now. I've seen their name. So even if it's not a person who has like a Hispanic name or anything like that, or African-American name, let's just say I took their name and somebody just gave me a bank statement. Halfway through, I know that customer. I've only gotten through 15 days of their transactions, and I know who that customer is. So we struggle. And part of it is that, and you said something like, oh, well, we're not making a lot of money. That's not the issue. Us not making a lot of money is another, we can do that in our second talk. You and I can talk about that in our second talk to the underwriter. That's a systemic issue that we have of not making money. It's what we do with the money we do make, because I'm not saying make more money, it fixes the problem. No, what I'm saying is, what can you do with the $25,000, or what are you doing with the $25,000 that you made? And a lot of us, because of culture and just because of all these systemic things that we have on us, we don't do the right thing. Because August, there are other nationalities who are only making $32,000 a year for a family of 4. And over 15 years, they saved $90,000 to put down on their.
And when you see these mortgages, you're like, oh, good, go, house, homeowner.
Yeah. Well, not just that. Like I said, I have control to approve. So when you're thinking about an underwriter, like I said, it's different now. There's oversight. If I turn a loan down, okay, let me put it to you this way. The banks are more at risk to have a rogue underwriter than you as a customer. Because if I approve a loan, nobody's checking behind me. So, once we sell the loan, it goes down. But I could approve a loan for people who are not creditworthy. Nobody's checking behind me. Now, it will get caught down line because we'll sell that loan to it may get picked for an audit. But that's the banks and the lenders are at risk. But declining a loan, I can't do without oversight. When I decline a loan, I have to write up the reason. I have to prove the reason I've declined it.
So are you saying are you saying, if I'm hearing right, they really want to approve this loan?
Okay, lenders don't make money if they don't make loans. That's how they make money. You're paying interest every month, and that extra interest that you're paying is going for their coffers, fattening them up. If they're not making the loans, they're not making no money. And if they originated a loan that they got to decline, that means the resources spent to originate that loan, pull credit reports, you ain't gonna probably, it's gonna be a mess. We just wasted money. So yes, we want to approve loans when we originate. We are not trying to decline loans. So when we have to decline a loan, we do everything we can not to, because we have, if it's at the point where underwriters looking at it today, not 20 years ago. 20 years ago, it was a lot more manual. But if it's at a point where underwriters looking at a loan, I have to decline a loan, somebody didn't do their job. It should have never even got to me. The customer, like I said, if we're following my the thing that I gave about remedial framework, and then you go do your research, the customer should know what they have and what they haven't by the time they even talk to the loan officer. And let's just say they didn't. Well, now the loan officer should have caught it before it got to me. So we're not in the business of declining loans. We're not.
And okay, so let me understand this. So we qualify ourselves. Let's to recap, because we only have 2 minutes left.
Oh, wow. Okay.
Yeah. So don't worry, we'll have you back.
Okay.
Because physical fitness is one aspect, but I'm concerned about physical fitness. I'm sorry, financial fitness.
Yes, very
Home
important.
ownership is a big thing right now, and there's a paradigm shift that's about to happen. We don't know how it's going to swing. But like you said, there's a group of people that know exactly what's going on.
Yeah.
And then we're going to miss the boat. Some of us don't. Some of us have bought and revamped and redid it. They went and got a home and flipped it and did everything. But it's very tricky now. So I just want to, just start from the beginning. I'm a new person. I want to think about buying a house. And let's just go through the bullets. First thing I do, no window shopping, right? Yeah. And I don't really necessarily need to go to a lender/broker. So you would say, what first thing to do is?
Go to Framework, which is a home buyer, first-time home buyer education. The name of it is Framework by Fannie Mae.
Okay.
And or Google, what do I do to buy a mortgage? Start there. That's where you start. Okay. Next thing, I'll tell you what not to do, because this is so important. I thought we were going to get to talk about it tonight. Do not. You're not going to listen to me, but do not use any type of credit repair or credit fix. Trust me when I tell you.
Oh, that's good, Ty.
Trust me when I tell you.
Because
There's nothing
they go ahead.
I told you, that's why I was texting you about the story with the gentleman. I'm going to get to tell it. I think I'm going to get him to come on and do a testimonial next time we talk. He told me the other day, he said, Ty, you don't even understand. You may have actually changed my life. And I'm going to tell you how that links. And I didn't even know. He said, I didn't tell you at the time, but do not do credit repair. Credit repair, to me, it's either a scam, one of two things, or the second thing is that means you're not invested enough to learn what your credit is, because the information is free. It is free. It is out there. It doesn't cost you any money to know your credit. It's your credit. So either you're not invested or you're being scammed. And neither one of those scenarios are a credit. You're not a good candidate to own.
Or you're not being forthright about your payment history because.
No. What I'm saying is, if you are at a point where you don't want to learn about credit on your own without paying someone, you're not invested enough to move on to the biggest purchase you're going to make in your life. Credit, what your credit is free for you to know. You can Google that, not credit repair, but how do I know what my credit looks like? You can Google that and it's free. Equifax, Experian, and TransUnion, depending on which state you're in, give you 1 to 2 free credit reports every single year. Okay, so you don't need someone to fix it. You don't need someone to do little tricks and pull things off and say that you really didn't run up that $1,000 credit card. That's not ethical. It's not moral. We as a culture should not be doing that. The shortcuts we need to take are 18 months doing a planned savings so you can buy that first house, and then do it again, and then do it again, and then do it again. That's the shortcut we should be taking.
Because at the end of the day, you said there's a deep dive. At the end of the day, you're going to see everything anyway.
No, that's not true. That's not even true. You could get away with it. I could get you that loan.
Wow.
And I taught you how to get something by ill-begotten means. For what purpose? Why do we, because we the ones doing it, it's not other races. Why do we have to take shortcuts when there's a right way to do it that is available to us? If you spent $1,000 on the Gucci bag, why, just because you can say it was the wrong address that they reported it on, I'm going to get it to you, and you okay with that? As a culture, that's not us. We don't have to do that, because you could just do it in line. You know, even if you owed the $1,000, you can call the people up and say, hey, I know I owe this $1,000. I didn't pay it or it's agreed. Will you work out some sort of deal with me? People take pennies on the dollar, pay it off, wait, and show your 18 months of on-time repayments, you know, to show you're credit worthy. Because to me, you're not credit worthy. You're a scammer. You just scammed your way into a house. And okay, some people say, well, yeah, I scammed my way into a house. I did it. That's not who we are. That's not the best of us. In August, I'm telling you, you know, there's a lot of white collar crime with a lot of other races and stuff like that. But we do that low level garbage stuff we ain't even got to do. If you want to be slick and stuff like that, because, you know, they say, well, the other people are doing it. Why are we at the bottom doing garbage can stuff? Pay your bills on time, be credit worthy, and buy a house, and then do it again in 18 months, and then do it again in 18 monts. And do
I
it
like
again.
that. I like that. And you've done it a godly way. Yes. And you have no regrets. There's no copy, cut and paste. I like that. Yeah. All right, Ty. Our time is up. So we went through 1, we got through the 2. There's so much more for a person for their first time. And thank you for the insight. I won't say tips and secrets, because like you said, it's readily available. So, but thank you for your insight as being, because you've been an originator, you've been a broker, you've been a lender, you've been, You've been underwriter, and you've actually done oversight. So, so you've done it in each scale with many different, well-known banks. So I thank you for your expertise, your time, and what you have. And we're going to have you back. We're going to end this one. And if you have any questions, I'll try to go back and put some points down to what she was saying, how important it is. But just know this, like she says, we don't have to do garbage can stuff. I like that, you know. And listen, you know, I believe that whatever you do, just, you know, God is going to bless you. Pray about it. Ask God. Don't try to go underhand, overhand, sneak, do things wrong. Let's just be upfront. 18 months seems like a long time when you want to buy a house right now.
No,
but I promise you, Titan has gotten me through. I've had to been told no several times, and then she has navigated and said, just take a deep breath. This is what you got to do. Pull your credit report. You know what it is. Make good on it. Call them, make arrangements, write a letter on why you were late. Why did this happen, and get all your ducks in order. And I mean, when we did that, me and Richard, my husband, it was like, we had to say, whoa, they just gave us the loan. And it was like, wait a minute. They was like, we want you to close quickly. And I was like, look at God, right? And then, of course, at the end, when we got to the finish line, they were like, wait a minute, where'd this $5,000 come from? And it was a gift from my other sister. It was a bona fide gift from my other sister. But they wanted to know where she got the money from, because she just sold a home in North Carolina, right? So she sold a home, and that was the proceeds from a home. But they weren't satisfied until they wanted to find out where my sister got the money. And she's like, you don't need to know my business. I just gave my sister money. But it doesn't work like that. And we'll talk about that more later. But it showed me that we had all of our ducks in order, but we needed to have more money in savings. Even though we had 3%, and even though we had some closing costs, we needed to have mortgage company required reserves. That's what it is, required reserves. And so they just wanted to know where the money came from. So now I know going next time. But it is amazing, guys. A home ownership is a straight path to wealth, generational wealth. Stay in there, stay focused, don't get frustrated. Please, whatever you do, the number one mistake I made with with getting a home was going window shopping. Okay. Don't do it. Get yourself ready. Get the information. And next time when we come on, we'll talk about some other ways that we can do the right thing. I like this one thing I take away from you. You say, listen, what'd you say? Pay your bills on time?
Overtime.
And then over time, you will start to see the process and it will work. And cut, copy, and paste every 18 months, which I didn't listen to my sister. At 18 months, I had equity in this home, and I should have cut, copy, and paste. Boom. We got to seize the moment, the market, that we have equity in our home. And I like what she said, do it every 18 months. And then we'll have, multiple homes, and then we'll be able to be like the bank.
Yeah, we want, and I'm not even talking about kids. I'm not talking about young people. If you were 40 years old and you did this every 2 years, at 50, you could have 5 properties.
Wow. That's me. That's going to be me. I mean, it's going to happen 50, when I'm 55, but it's good.
Yeah, but if you were 50 and you did it every 2 years at 60, you'd have 5 properties. You know what I mean? And you roll off into your retirement with some additional passive income, hopefully, and then also someone else paying into your savings account, because we're going to call the house a savings account. We won't call it the biggest equity win. But on a side note, August, please share with them your first home. You did a 203K.
Oh, yes, I did.
How much money did you make? And this is now, because we got to talk about buying smart. We'll do that another time.
But I'll just give you a little sneak. So my first home my sister talked me into or talked to us about getting a 203K. And we bought the house for 89,000, and we sold the house for $300,000. It was bananas. Could not believe it. Lived in the house for 8 years. I'm sorry, not 8 years, 6 years, I believe it was, something like that. And it was amazing. And the 203K loan helped us to fix it up, to make it like new bathrooms, new kitchen. It was amazing. And my sister said, if you can live through the renovation, if you could go through just a little time, see, that's what it is, the patience and the time. If you could take the time and do it and research and do it the right way, and a little bit of sweat equity. And then we pulled out of the home with the 203K. We bought the home for 89. With the 203K, it was 116, 117, something like that, right? So we put like 30-something thousand in it. And then we sold it, and we made over almost 190 after it was all said and done. Come on, 190,000.
and I hate to say this because, we roll back some of those capital gains taxes. I'm not an accountant, so I don't even play one on TV. I don't mess with that. But just know up until this year, it's this tax 2022, you didn't even have to pay tax on a primary residence that you made capital gains on. So if you made $250,000, that was not, you didn't have to pay taxes on that.
Yeah, well, we didn't pay taxes because back
at the time, the capital gains tax, you didn't have to pay it. Now there was some laws that were rolled back, I think, in this tax year. So like I said, I'm not an accountant, but it was, what I'm saying is what I'm saying. It was still money, it was passive income. So it is still a good,
Yeah, 203.
That was one of those success stories. And I don't want everyone to think that always happens. But what I'm saying is if you buy smart and you do it every 18 months, and let me tell you, 18 months goes by fast. And I'm not talking about people who make a lot of money. I'm talking about regular folks who don't make a lot of money. And I say 18 months because you need 18 months to get some savings up because everything is going to cost money. These people will tell you, oh, there's a way to do it. You don't need anything down. I'm just trying to talk to the regular person who doesn't have the hookup here. You're not trying to stretch it. This is like I don't want to say safe. This is just like the normal process, the normal way to get to where you're going. So that's it. And August, if people have any questions, if they watch this, go ahead and have them. What is it called? What's the thing with Facebook?
Messenger. I'll have them message you. But Thank you guys. Good night. Again, this is Fitness by August. I'm August Williams, founder. And I not only care about you physically getting healthy and your nutrition and helping you to get to optimal health, but also spiritually and financially. So it's important. And in this season, as you're getting fit and you're getting strong and, your finances need to be also healthy and strong and fit. And one way to do that is home ownership, but we have to, we have to do it the right way. So again, thank you, Titine Humes. I appreciate you, all of your information. Again, you've helped me and countless others to get into home ownership the right way. So, and I don't have to wait for the hammer to drop, or if I did something illegal, I get busted. No, it was done with integrity, and my hands are clean, and I can help someone else to do it the right way. So, all right, we're going to call it a night. Thank you all again. Thank you, Titine Humes. Leave your questions, DM me if you have any other questions for Miss Humes. She will give you that information. And listen, starting today, till 18 months, or maybe not 18 months, maybe 15 months. Who knows? The more you start saving, right? Am I right, Titine? The less that time is.
Saving and getting an understanding.
Getting an understanding.
Giving an understanding. For the high income folks, this doesn't really apply to you. You don't have to go 18 months because you usually have a lot more, what they call it, residual income. But for folks who are regular people, working people who finances are already stretched, it's about, I think they call it laying the bricks, or what does James Clearly call it, stacking. This is getting you used to stacking that couple $100 a month. You're laying the bricks every couple of $100 a month to get you ready so that when you start the process. And then by then, when you go into start looking and you get your loan officer, a lot of stuff is not going to surprise you. Then you'll be able to focus your attention on the thing that's going to possibly help you with wealth. And that will be buying smart. That's when because you won't have to.
That's a whole nother thing. Next time.
You won't have to worry about the finances because you can focus on, okay, now what's the smartest way for me to buy?
Where to buy? Is it this property good? I experienced that with this third home of mine. Yeah. I experienced that. I wasn't worried. I was approved. We were approved. We had everything in order. And now I can really take my time and well, not in this market because they will buy right from under you, but putting in bids and looking attractive to home buyers and having your letter ready to give because there's a pool of other buyers. That's a whole other thing. But I was able to focus, like, where do I want to live? Is this area going to be built up? Are they building up, malls and stuff? Are they getting ready to put new schools in? I can kind of track things where my investment, like Titine said, this is really your savings and you're just maintenance on your savings. So it's amazing. Oh, we can go on. But we're going to go ahead and end right now. Thank you all for your patience, and we will see you soon. All right. See you later. Bye-bye.